All right. I think we're about ready to get started. Just to answer your question right quick, Brittany, yep, this session is going to be recorded and we'll be sending it out at the end as well. So we're excited to walk everyone through 7 key strategies that we've seen work especially well for tech professionals, helping you reduce taxes and meaningfully increase your savings. My name is Mike O'Connor. I'm part of the growth team here at Alfonso, and I've been in tech and working with startups for over 5 years now, from bootstrap small teams to Series C and beyond. I'm a big reader, everything from nonfiction to epic fantasy. So feel free to post some book recommendations in the chat, along with any questions that you might have throughout the presentation. And we'll do a Q&A at the end as well to go through a lot of those questions. Our speaker today is Rupesh. He is the senior financial advisor at Alfonso. He has over 10 years of experience. He's an MBA from Boston College, a CFA charter holder. And before Alfonso, he managed about $300 million in a hedge fund focused on portfolio management. These days, he works specifically with tech employees, navigating equity compensation, RSUs, ISOs, ESPPs, and all the tax complexity that comes with that. So I will go ahead and pass it over to Rupesh.
Thank you, Mike, and thanks all for joining in. Excited to be here and talking about these strategies that you can implement starting tonight in your accounts that can pay off immediately as well as 25 years from now. In today's webinar, we'll talk about tax loss harvesting and direct indexing as our first strategy. Then we'll also talk about how to turn a scary market as your friend. Then the employee-specific stuff such as your ESPP and the cost basis trap that quietly cost people thousands of dollars. We'll also go through Roth conversions, the mega backdoor, Roths, which honestly is one of the most underused benefits in your 401k. We'll also talk about charitable giving and then finally about tax withholding, because if you have never seen the golden words that says you owe an extra $20,000 during your tax filing in April, congratulations. We want to keep it that way. So with that, let's get started. So the first strategy here we're going to discuss is tax loss harvesting, which is generally done through direct indexing. Quick reset on what this actually is. Most of you, when you buy a single fund such as VOO, QQQ, that one ticker holds hundreds of companies in one neat package. Direct indexing flips it around. So instead of buying that one particular fund, you owe hundreds of stocks individually that reside inside that particular fund. Same exposure, same returns, just unbundled. So why on earth you would do something like that? Because the market is never up evenly. So in any given year, the index might be up 10%, but inside of it, many individual stocks will be down. So with the fund, you cannot see them as they are hidden inside a wrapper. But with direct indexing, you can see them, you can sell them, and book these losses for tax purposes and immediately rebuy them as well. Or you can buy similar stocks to avoid the wash sale rule. So what that entails to, so that results in the same investment performance plus a tax assets, which we call as a coupon that you can use to offset your other capital gains, as well as reduce your taxable income to a certain extent. The technology that makes this affordable was private bank only, let's say 5 years ago. But today, you can get access to these kinds of strategies through your financial advisors or with some standalone firms such as FREC, which provide that indexing. So in terms of the financial impact, what are the numbers that we are looking here? Let's make it in real life. You're working at Amazon. You've been there for 6 years. You have your RSUs and you've been selling them at vesting, building your portfolio with investments in ETF such as SPY, QQQ. So even in a flat year where there were no market returns, in a portfolio of $300,000, you can usually harvest about $40,000 of losses. And that's normal. That's not just in a down market. It's just a natural dispersion underneath the index. And apply your marginal rate, and your capital gain on that stock losses. So that $40,000 can save you about $8,500 in taxes in just 1 year alone. And this is not an investment performance. This is not a skill. This is just IRS handing back you the money that you would have eventually written them for. Same portfolios, again, same risk, that money in your pocket. That's it. Do that for 10 years, reinvest it, compound it, and we are talking real money. That kind of money can fund your college education for your child and help you retire a few years earlier. So let's talk about the second strategy, which is turning volatility into tax savings. There is an old line on Wall Street that says the market climbs a wall of worry. But what they don't say is that even a wall of worry is also a wall of tax opportunity. So most people, when the markets drop, they do one of the two things. Either they do a panic sell or they just freeze and let it be. We believe both of these are mistakes. The sophisticated move is to see the down day and look for what tax moves got cheaper that day. So then three things that generally get cheaper in the down market. The one is losses sitting on the table. That is free to harvest. That's something we just covered in previous slide where you just sell it based on whatever the stocks are down. Second, Roth conversions. So if you are converting hundreds and thousands of dollars from traditional IRA to Roth, you would much rather do it in a down market when it's, let's say, 15% down and you are paying taxes on $85,000 rather than that $100K. And when the conversion is done, that money is going to grow tax-free forever. And lastly, the incentive stock options. So let's say if you have some ISOs from your previous employer, exercising them in a down year reduces your AMT exposure as well, often dramatically reducing your taxes in that particular year. So next time, when you see the markets falling, ask just this one question. What's on sale today? And what can I do to make this volatility as my friend and IRS enemy? So let's take a look at what the financial impact looks like for this. Before, let's give you a few seconds to kind of take this poll.
And while folks are finishing up the poll, you can go ahead and type in any questions you might have about either of these strategies as well while they're top of mind.
Good. So let's continue. Let's look at the financial impact here. So picture the same scenario where you're working as an Amazon employee, but now consider a year like a 2022 when the markets were getting melted, and they were down more than 15%. So what was happening? Your colleagues were miserable. They were checking their E-Trade accounts, fidelities between the stand-ups, and getting aging real time. So what can you do? First, you do the loss harvesting, which we showed earlier, and make 8,500 roughly in tax savings. Second, let's say it was also a relatively low income year for you. And what you do is you convert $50,000 of your old traditional IRA or your 401k that was there from your previous employer and convert it into Roth. The market is down, so you pay taxes on a much smaller number than the actual number. That is another $4,000 roughly saved. And then from there forward, that money is going to grow tax-free forever. And lastly, let's say you also had some ISOs from your previous employer. The stock dipped more than 20%, meaning the spread on these options shrank dramatically. That means you can exercise the shares now at a much lower price and dodge a big chunk of AMT, which can be as high as $3,400 just on that one particular stock. So in one bad year, while your peers were doom and scrolling things, you put tens of thousands of dollars back in your pocket with same portfolios, same job, same paycheck. That is the difference between watching the markets and working the markets. And none of it requires you to kind of predict anything. Just take actions. So let's take a look at strategy three, which is the ESPP and the trap that actually lives inside it. Quick housekeeping. If your company offers ESPP and you are not maxing it, you're actually leaving money on a sidewalk that you walk past every 2 weeks. So step one here, max it. If the cash flow allows it, obviously fully fund it. Step two, and this might be controversial one. Me, you already work there, you already have your RSUs mostly, your career is your retirement, your kids' college education fund are already riding on that stock. ESPP shares are generally concentration risk on top of the concentration risk. So what we believe, you should take the discount, sell the shares, redeploy it in a diversified portfolio. That math is unambiguous. Now let's talk about the trap that resides inside the ESPP. So this year, actually, more than 50% of the new people that I've worked with filed their taxes incorrectly. And these are really, really smart people, engineers, managers who are not aware of this at all. Why? Because the brokers that provide you the reports for these ESPPs, which is called the 1099B, they report the cost basis incorrectly. They report what you paid. They don't report the discount that was already there and the taxes that you actually paid on those discounts. So what you do, you end up paying taxes two times on that same dollar amount. The fix is simple. Track the ESPP using the form 3922 that your employer provides, or you can go to your detailed broker statements from your financial institution annually and adjust the cost basis accordingly. In fact, we are looking at. So imagine you're a Microsoft engineer, you've been working there for 4 years now, you've been quietly putting 15% of your paycheck into ESPP cycle every year. You have sold some shares along the way as well. You filed your taxes through TurboTax and you import your 1099B and you click on submit. That, right? Well, let me show you how it kind of actually happened. So if you look at the table here, the shares you had purchased were, let's say, roughly $50,000. The income that was already taxed on your W-2 is the 15% discount, which you got it in form of the compensation, which here is $7,500. And now let's say the stock was up 10% and your holding stock was 55K, which you completely sold. Now the 1099B here, which will be given by your broker, tells IRS that your cost basis is $42,500, meaning your gains now here looks like 12,500. But the actual gain is just $5,000 because on that $7,500, you've already paid taxes via your W-2 through your employer. And bless IRS, they are happy to charge you again on those. So double taxation in this kind of scenario costed you around $1,500. Multiply this with 4 cycles and 4 years, we're talking again real money. So next, we'll talk about the optimal Roth conversion sequencing. So Roth IRA is the closest thing in the US code, tax code, which we call it as magic. So you put the money in there once, pay tax there once, and from that day onwards, every dollar of growth, every dollar of withdrawal after 59 and a half years of age is tax-free for the rest of your life. What's the catch? Well, there is a limit in which to how much you can kind of contribute. And then you obviously pay taxes at least once on the money before you put in these kinds of accounts. So the question becomes when you should be kind of doing it. To that answer is when the tax bill is the cheapest, which is when your income is generally low. So for most of you, the income is high, and frankly, it should be. These are your peak years, or in terms of your earnings. But life has a rhythm. There are certain scenarios that comes along the way, like sabbaticals, job transitions, the years between leaving jobs, starting your next gig, early retirement, spouse or you going to grad school, maternity, paternity leave, anything can happen. And that can, affect your payroll to a certain extent. So those kinds of low income years can have silver lining in form of these Roth conversions. You can convert the chunk of this pre-tax money at a lower tax rate, let's say 22%, which is kind of recommended. When in a normal year, if you were to kind of convert it, you would be taxed at 37% rate. So this 15-point gap can be applied to hundreds and thousands of dollars, which results in savings as well as growth, which is also tax-free. So what's the golden rule here, is every December before the year closes, look at the runway and ask, did anything changed in terms of your salaries and in terms of your overall income? And is there a window for your Roth conversion before the calendar year ends? So most years, I know it will be a no, but if there is, go for it, do it aggressively. So what's the financial impact we are looking at? So here is what I want to picture, want you to picture something. So imagine yourself, it's been 3 years from now, you've been working at Amazon for 8 years. You have two young kids and you and your spouse have been talking about that thing where you take a year off for travel and being at home for your kids before they hit the middle school. You have the savings and you've been planning, so everything looks all good on the paper. So that gap year can be a very, very valuable year for you, for your future life, because it's not the highest earning. The most valuable thing is your conversion. So let's say you convert $75,000 of your old 401k pre-tax into Roth. Normally, that conversion, if you would do, would result in 37% in taxes. But given it was a low tax year, it, let's say, gets converted into 22%, which results in immediate savings of $11,250. But here is the real kicker. That's $25,000 that's sitting in your Roth. Now compound it to, let's say, 25 years, which is tax free now. At a meager 7% growth rate, it grows to roughly $400,000. The taxes saved on that growth is another $98,000, another real money. So on one strategic decision in a one strategic year is worth roughly 110K for your family. Most people never take a pause and take a look at this. The others who do, well, they retire a few years earlier than the rest. Let's give you some time for this poll.
And again, see some good questions coming into the chat. If you have any questions on those strategies, make sure you ask them while they're fresh on your mind, and we're going to answer them at the Q&A at the end.
So let's continue. The strategy 5 is the mega backdoor one, also known as the best 401k feature that you may have never used. So quick refresher, most of you know the standard 401k limit is $24,500 in a year pre-tax contribution or post-tax contribution. Your employer also, I'm assuming, adds a match. So roughly 50% of it, call it 12 grand. So far, 36,500 is all set for you on a yearly basis in your 401k. What people don't realize is that IRS lets you put a total of $72,000 in a year into your 401k. So the question is, what to do with this gap? Where is this money? How this money can be filled in? And it's critical because most of the big tech firms, such as Amazon, Microsoft, Google, Meta, allow these after-tax contributions. So here is how it works. After you max out your normal 24,500, and after the match goes in, you keep on contributing into a special after-tax bundle inside the 401k. The money goes inside it is already taxed, which is, could be from RSUs or from your base pay. Then, and this is the trick, you immediately convert that after-tax money into Roth. That can be done either inside the plan or via your in-service rollover, which your company will most likely provide. The result, you just got an extra $35,500 a year into your Roth account, which is far above the normal Roth contributions, which is around $7,000, which can be done via the backdoor channel for people who are earning as high as probably you guys. So in terms of the financial impact, picture yourself again. I've been working at Amazon for a while. You said you decided the goal is not to grind until 65. The goal is to retire, and retire on your terms by, let's say, 55. So you want time back. So what you do for the next 13 years, what you max the mega back to Roth every single year. So that's roughly $35,000 of your after-tax 401k contributions converted into Roth. So let's say this money grows at 7% annually, and this bucket alone, after you retire, grows to about $2.2 million. And the best part, it's all tax free. Whenever you take it out, you never pay taxes either on the capital gains or on the income. This is tax free for life. And if that money were to be in a, let's say, a regular brokerage account, which you are kind of accumulating over the years through your savings, you would pay along a capital gain on every withdrawal. So on a normal retirement sprint down, that's about $285,000 in capital gains, which you avoided through this mega backdoor Roth. And on top of that, there is another thing called required minimum distribution as well. So you don't have to do the taxes on that as well because Roth is above and beyond it. So that's another $55,000 saved. Total 340K. That's the real money we are talking just from this one particular benefit. We already probably have the access. So if one key thing that you want to take away from this entire webinar is this: open your benefits today, for your benefits, search for after tax 401k. And if your plan supports it, and if your financials and your cash flow supports it, turn it on now, not tomorrow, today. This is the single highest leverage that is available to you that you can take the benefit. So let's talk about strategy number 6, which is charitable giving with appreciated stock. So this strategy is probably for subset of you guys who already give some money to the causes that you care about. That could be your church, your alma mater, the food bank, climate, mental health, or whatever you believe in. So if giving is already part of your life, this is the strategy that makes your generosity go even significantly further. So here's the principle. So most people give the money their parents probably were giving. Write a check or tap on a button on charity's website and pay it with your credit card. That works. But for anyone in this room, we believe that way is wrong. The right way is not to donate via cash or credit card, but through appreciated stock. Here is why. When you donate your appreciated stock, that could be shares from your RSUs that you have held over the years, or when you got the equity when you started in your company. Two beautiful things here can happen at the same time. One, you get tax deduction for the full market value when you kind of donate it. Two, you completely avoid paying capital gains on the appreciation. Compare that to selling first, paying the capital gains, and then donating the cash, which is the leftover. So what you did was you paid tax for no reasons, the charity gets less, the IRS gets more. Ultimately, nobody wins but the IRS. So the cleanest way to do is through at scale is through a fund called Donor Advisor Fund, which is called DAFs. So you contribute the stock once, take the deductions, and grant the money out to the charity over years. So bunch your giving in your high income years and spread the granting. So in terms of the financial impact, what we are looking at here is imagine you and your spouse give charity of about $20,000 every year. And right now, most of what you are doing is through cash or out of your checking account, which is easy, automatic, and doesn't require thinking. So let's change the tactics. So that same $20,000, but now this comes out from your Amazon stock that you bought, that you got it from the company 4 years ago. Let's say for $5,000. So there is $15,000 of capital gain that is inside that particular position. So now two things happen here. One, you don't pay any capital gain on that $15,000 when you convert this money into a DAF, which is donor advisor fund. And if you were to kind of, let's say, do a capital gain tax rate of 23.8% on this $15,000, that's roughly $3,500 saved right there. Two, you also get a charitable deductions for the full $20,000, let's say at your marginal tax rate of 37%, which comes to be another $7,400 savings for your taxes. So the total savings on your $20,000 of charity giving is around $10,000, $10,970 actually. So which is more than half of what you actually paid. This money would have gone to just IRS. Instead, this is gone for a even better reason, which is through the charity and obviously to you as well. And your bank account is also 11K more healthier. So now bunch this, do this, let's say 5 years of giving in one big year. Say if there was a big year with your IPO acquisition or through a mega vesting schedule that happened, this stacking deduction can help you increase your charity as well as reduce your taxes. Okay, so the last strategy is withholding and estimated payments, the one that probably cost more people more pain than any other. Most people pay attention to their compensation, what we're getting on RSUs, what we're getting on bonuses, salaries, ESPP, but almost nobody pays attention to what is actually being withheld. So here's the catch. By default, your company withholds around 22% on your supplemental wages. That is RSUs, bonuses, any refresh grants. But your actual margin tax rate, if you are in this room, most likely is 35% or higher. And that's just at a federal level alone. So every time you have a big vest, the IRS is under collecting by up to 15% on every dollar that is being vested. So when the bill comes due in April, it's a very large bill for you. And on top of that, the IRS adds a penalty for under withholding the current taxes, which is around 8% at least of the amount that was not paid. So what you are doing is you are paying interest on top of the tax, which looks like, it's an insult to an injury. So there are two ways to kind of fix it. So either you bump up your W-4 withholding directly through your employer portal to that particular amount, or second, you write quarterly estimated payments to the IRS yourself by estimating it. And here, the most important thing to know is your safe harbor rule. So as long as you paid either 110% of your previous year's taxes or 90% of this year's actual tax, they don't penalize you. So hit one of those two numbers and you are at least protected from the penalties from the IRS. So in terms of financial impact, let's say again, you're working at Amazon, you had RSUs vested for 200K, which was probably because of the backloading vesting schedule that you have. So big number, real money. So what Amazon does is Amazon withhold 22%, so that's $44,000 sent to the IRS. But your actual taxes was much higher, let's say $74,000 on 37% gap tax rate. So the gap here is 30%, $30,000 just for that. And if you do nothing, you discover this in April when you file turbo taxes. You owe $30,000 in taxes plus an 8% penalties for under withholding, which could be around $2,400, which is pure waste, which could have easily been avoided. So putting this all together, I know because 7 strategies is a lot and your brain might be full. So here is what I want you to think about this. Not a checklist, as a kind of a playbook. So there are 4 playbooks associated And it depends upon what kind of year you are having and what kind of strategies you can kind of implement. So let's take a look at the normal year, which is every year. So there are four things which are absolutely non-negotiable. The first, verify your withholding versus your true marginal tax rate and pay the gap in terms of the taxes that you are under withholding. Second, max out your mega backdoor Roth. Third, max your ESPP and audit your past sales for cost basis trap in order to avoid pay double taxes. And lastly, do a end of year loss harvest sweep. Reduce your capital gains through that and reduce your taxable income through it. Those four every year, no exceptions. Let's look at it in a big income year. So let's say if you had an IPO, a secondary offering, Mega West acquisition bonus, switch playbooks. Now, in in addition to what you need to do in every year, you bunch it with charitable giving, which is via our DAF, making the estimated payments again in taxes to nail the safe harbor, and deferring any Roth conversions to a future low income year because you don't want to convert at such a high tax rate. Third, in a down market year, this is where a red playbook lights up. Aggressively loss harvesting and do a direct indexing because you would probably get more out of down year. Roth conversions to be done at a depressed values. ISO exercise if you have any ISOs to be done at a depressed value of that particular share. Reset the cost basis for your long-term growth. And lastly, in a low income year, let's say you had sabbaticals between the jobs, and if you did early retirement, flip into harvest mode. So convert your pre-tax money, like your 401ks, your IRS to Roth, up to a rate where it is 22% of your tax bracket. Harvest long-term capital gains at a 0% bracket as well if they are available, and then reevaluate and your annual giving cadence and postpone it to maybe some high income years. That's the framework. Four scenarios, the strategies don't change, the order does. And honestly, having someone in your corner who knows which playbook you are in every year is what separates the people who pay too much in taxes and people who pay just enough. With that, I'll pass on to Mike for the next Q&A session.
Awesome. Thank you, Rupesh. It really never ceases to amaze me what's possible when you have the right strategies. And now I'm going to start reading off some of the questions in the chat for the Q&A. If anyone has any more that they think of, I will get to those as well. So let's go ahead and start off. What is the cost of direct indexing through something like FREC?
I think it depends upon the strategy, but most of the times they charge you cost basis, like a management fees, which could be around 0.25%, starting with. So let's say on 100K, we are looking at least $250 to begin with. And yeah, I mean, if the strategy is more complicated, they're going to probably charge you more.
Okay. And Rajiv says tax loss harvesting assumes you at least partially shed your losers, then you are no longer tracking that index. I guess that was more of a statement than a question, but is that correct?
Sorry, I didn't get it. Can you repeat, Mike?
Yeah. Tax loss harvesting assumes that you shed your losers, then you are no longer tracking that index.
Yeah, exactly. So I mean, you replace them with similar stocks as well, or you wait it out for 30 days to avoid the wash sale rule. So generally, we recommend that you do this kind of harvesting also when there is not much kind of activities going around. Let's say earnings season is over, and the stock is still down. So that's a good time to kind of sell those particular stocks. But obviously, if you want to absolutely reduce your exposure to, you can always buy similar stocks. There are always stocks which provide you, let's say 70, 80, or at least 90% of overlap of what that stock is.
If I harvest a loss, how quickly can I rebuy the same stock or fund to avoid a wash sale?
30 days.
30 days. Quick and easy. If I hold for ESPP for 2 years after a qualifying disposition, isn't that better for taxes overall? Why sell immediately?
Yeah, again, I mean, you're right. If let's say you don't hold the stock that much, then and you are looking at probably the long-term growth, then yes, at long-term tax rate, this is going to be taxed at a lower tax bracket than let's say if you were to sell at less than two years of holding. But we are talking about selling it immediately once it's kind of let's say purchased in your account. So in that case, most likely you won't have any capital gain. What you are doing is taking that money and deploying it in a more diversified fund, which can provide you less concentration risk. So here you are just paying you're just taking in that 15% as your income on your paycheck and you are paying taxes on it, which you would anyway do it. So what you're doing is taking the proceeds and just deploying it elsewhere rather than putting in that particular stock where you already work and where you probably have the RSUs as well.
Got it. And for ESPP, if I've been filing taxes incorrectly for the past few years due to the 1099B trap, can I amend my returns to get that money back?
Absolutely. You can do that. Um, the only caveat to it is IRS only allows up to 3 years of changes. So you can do it for the past 3 years, but not beyond that particular period.
Is there any penalty when I move pre-tax money out of an old 401k and into a Roth IRA during a sabbatical?
Nope, no penalties. The only thing is, you're gonna be taxed at whatever tax rate it's gonna be. So basically, they're gonna take this as a earning for you, and they're gonna tax you on that. So no penalties. You just move that money from your taxable account, your 401k, which is to Roth, which is never gonna be taxed again.
Hmm. And my plan says it offers after-tax contributions, but doesn't specifically mention mega backdoor Roth. Is it the
Yeah,
same
that's the same
thing?
thing. Yep,
Okay,
yep, that's the same thing. Yeah. So they don't explicitly say that. It's a more like a advisor terminology that says mega backdoor, but that's something the company uses.
gotcha. And the second part was how do I do the in-service rollover?
I think within the portal, you will see that option as well. They would say that immediately do a rollover. So you just check that particular option out. And that would mean that you're also doing a conversion as well once you end up doing the contributions.
Does the donated stock have to be from RSUs, or can I donate any appreciated stock I've held for a
Any
while?
appreciated stock. Yep, any appreciated stock, as long as capital gains are associated with it, which is obviously to your benefit, you can move it to the donor advisor fund.
For charitable donations, isn't there an IRS limit to it?
I mean, it is if your income is, I mean, generally we recommended doing it in a year where your income is high. So Um, probably if you do like more than 50% of your income into charities, then yes, obviously there is a limit. But generally, we don't hit that particular limit pretty easily. So while there are limits, and you have to be careful in terms of how much you kind of take it in a 1 year, but generally that's not hit it.
I have a SEP IRA that has a significant balance from a prior self-employment. Do you recommend converting it to a Roth IRA now, switching it to my employer's 401k, or something else? I'm about 20 years from retirement.
Yeah, I mean, it depends. Very specific question in terms of your scenario. For example, what's your income is going to be for this particular year? What's the options that you have for investments in that particular plan? And then what's the let's say, options your current employer is providing in the plan, and what's the cost that's associated with your SEP IRA and your employer 401k. So unless we don't know those questions, we won't be able to answer that. Maybe after the call, we can do a session and we can discuss in depth.
And during the current climate of the SaaS apocalypse and market volatility, the built-in discount of 15% from ESPPs seems no longer guaranteed or not worth the concentration risk. Do you agree?
Again, it depends upon how much you already hold. So let's say if it is less than 10% of your portfolio, then maybe yes, it's better you kind of keep on accumulating more because it might be at a discount right now, and that might help you gain more further in the few years down the line when the markets kind of recover and there is this exaggeration or overreaction to the SaaS meltdown is over. But let's say you already own more than 20% of your portfolio in that particular stock, and you obviously is already working there as well. So then it may not be worth it for you to kind of hold that particular stock and wait it to ride out of this storm because you never know whether this storm is gonna kind of go away. And that may affect your wealth very, very significantly because of your concentration. So yeah, it might be a risk that might not be worth taking for you.
Got it. That looks like it's it for questions. So we'll go ahead and wrap things up. And we will be sending out this whole deck as well as the recording to everyone with a link to book a one-on-one session with an advisor so that you can ask questions that are specific to your situation, because we know that everyone's got something different going on. So we want to make sure we can answer any questions that you have going forward. So we really appreciate y'all for coming, and we'll see you again soon.